Pop quiz. You open your brokerage app right now and see 10 shares of Apple sitting in your account. Who actually owns those shares? If you answered, I do, you just failed the most important financial literacy test of your life. Let me show you something that should terrify every American with money in the stock market. I'm going to read you the actual legal text from the Uniform Commercial Code, Article 8, Section 501. This is the law that governs securities ownership in our country. It says that when you buy a stock through a broker, you acquire a security entitlement to a financial asset maintained by a securities intermediary, not ownership, not property rights, and entitlement. What's the difference? Everything. Here's what actually happened when you clicked buy on that Apple stock. You sent your money to your brokerage. The brokerage sent instructions to a clearinghouse. The clearinghouse updated a ledger at an entity called the Depository Trust and Clearing Corporation, or DTCC, and somewhere in a massive pooled account, a notation changed. But the actual share certificate, the legal title to that piece of Apple, never moved to your name. It stayed registered to a company you've probably never heard of, called C-Day & Company, which is the nominee name for the DTCC. You became what the law calls a beneficial owner. They remained the registered owner. You have the right to profits and gains. They have the actual property rights to the asset itself. Think of it this way. You saved up money and decided to buy a hotel room as an investment property. You go online, you click purchase, you send your payment, and you get a confirmation email. You check your account, and it says, 1 hotel room, owned. You feel great. You're a property owner now. Then you read the fine print in your contract, and you discover something disturbing. You don't actually own the hotel room. The hotel still owns it. What you purchased was a permanent reservation. You get the benefits of the room when you want to use it. You get paid if the hotel rents it out to someone else. But the deed to that room stays in the hotel's name. And here's the kicker. If the hotel goes bankrupt, your reservation becomes a general claim in bankruptcy court. You're standing in line behind the secured creditors who financed the hotel's construction. The room you thought you owned becomes collateral for someone else's debt. This isn't a metaphor. This is the precise legal structure of stock ownership in America today. According to the DTCC's own documentation, they hold over $63 trillion in securities in their nominee name. That's every share of every company held by every retail investor through every major brokerage in the country. Fidelity, Schwab, Robinhood, E-Trade, all of them. When you look at your account and see your shares, what you're actually looking at is your broker's promise to deliver the economic benefits of shares that are legally titled to someone else. For decades, this system worked fine. The distinction between registered ownership and beneficial ownership didn't matter in practical terms because the system was stable. If you wanted to sell your Apple shares, your broker would find a buyer, adjust some ledgers, and you'd get your cash. The legal technicality of who actually owned the underlying asset was invisible. But here's what should grab our attention. That stability is ending. We're heading into 2026 with the largest debt bubble in human history, a derivatives market exceeding $600 trillion, and a commercial real estate sector on the verge of collapse. The Federal Reserve has already acknowledged in internal reports that the banking system faces potentially catastrophic losses. Multiple Federal Reserve governors have given speeches warning about systemic risk in the securities lending market. The Bank for International Settlements published a paper noting that the collateral chains in our financial system have become so interconnected that a single major default could trigger cascading failures across the entire network. When that happens, when we hit the next 2008 level crisis or worse, this legal distinction between what you think you own and what you actually own becomes the most important thing in your financial life. Because in a bankruptcy, property rights matter, and you don't have them. Let me put this in perspective. You've spent years building your retirement portfolio. You've been disciplined. You've dollar cost averaged into index funds. You've watched your account grow to $200,000, maybe $500,000. You check it regularly, the numbers are there, the shares are listed. According to every normal measure, you're a responsible investor who owns a diversified portfolio of American companies. But according to the Uniform Commercial Code, you own a contractual claim against your brokerage firm for the delivery of securities that are held in a pooled account at a central depository. Your ownership is one legal layer removed from the actual asset. Why does this matter? Because that extra layer creates what financial lawyers call counterparty risk. Your ability to access the value of your shares depends entirely on your broker's financial solvency and their willingness to honor your entitlement. In a normal functioning market, that's not a problem. Brokers are regulated, insured, and backed by the full faith and credit of the system. But what happens when the system itself is failing? What happens when your broker is facing its own liquidity crisis? What happens when the secured creditors who lent your broker money to run their operations start demanding collateral? This is where the architecture of modern finance reveals its true nature. Your shares, the ones you think you own, are sitting in a custodial account held by entities like JP Morgan Chase, State Street, or Bank of New York Mellon. These custody banks provide services to your broker. And here's the critical part. Those custodians use the pooled securities in their possession as collateral for their own financing operations. The shares you purchased with your hard-earned money are being rehypothecated, which is a fancy term for pledged multiple times as collateral for different loans. According to securities lending data from IHS Markit, over $2 trillion in U.S. equities are currently on loan to hedge funds and other institutional borrowers. These are shares that belong to retail investors who have no idea their assets are being lent out. The system works beautifully when asset prices are rising and everyone can meet their obligations. But have you noticed what's been happening to financial stability indicators? The Federal Deposit Insurance Corporation's quarterly banking profile showed that unrealized losses on bank balance sheets hit over $500 billion in recent quarters. Commercial real estate delinquencies are accelerating, according to TREP and Morgan Stanley research. Corporate debt refinancing needs are approaching historic levels just as interest rates remain elevated. Credit default swap spreads on major financial institutions are widening, which means the market is pricing in higher bankruptcy risk for the very entities holding your security entitlements. We're approaching 2026 with a perfect storm brewing. The debt that corporations took on during the zero interest rate era is coming due. Regional banks are sitting on massive unrealized losses. The derivatives market is more leveraged than it was in 2008. And the legal structure that's supposed to protect your investments was designed by the very institutions that benefit when the system fails. They wrote the rules, they control the infrastructure, and they made sure that in a crisis, they get paid first. This isn't conspiracy theory. This is conspiracy fact. The laws are public. The court precedents are established. The bankruptcy priority rules are clear. What's hidden is the awareness. 99% of Americans who own stocks have no idea that they don't actually own them. They've never read the account agreement they signed with their broker. They've never looked up UCC Article 8. They've never asked what happens to their shares if their brokerage fails. And the financial industry has no incentive to educate them because the entire system depends on millions of retail investors believing they're owners when legally they're just unsecured creditors with a contractual claim. The question isn't whether this legal structure exists. It does. The question is whether it matters. And the answer is, it only matters when the system breaks. In 2026, when the derivatives unwind and the banks start failing, you're going to learn very quickly that the difference between being a registered owner and a beneficial owner is the difference between keeping your life savings and losing everything while lawyers argue in bankruptcy court about whose claim has priority. Your stocks aren't in your name, they're in street name. And when the street goes bankrupt, you're going to wish you understood what that meant. Now, let me show you exactly how the confiscation happens. This isn't theory. The legal mechanism is already in place. It's been tested in multiple countries, and it's written into American law right now. Remember those shares sitting in your brokerage account? The ones that are actually held in a pooled account at the DTCC. Here's what your broker is doing with them while you sleep. They're taking those pooled securities and delivering them to their custodian bank. Let's say it's JP Morgan Chase. JP Morgan holds these securities in what's called a securities account. And then JP Morgan does something that should make every investor's blood run cold. They use your shares as collateral for their own derivative positions. This is completely legal. It's called rehypothecation. The International Monetary Fund published research showing that in the lead up to the 2008 crisis, major banks were rehypothecating collateral at ratios as high as 4-1. That means the same share of stock was being used as collateral for 4 different loans simultaneously. Your Apple share wasn't just backing your broker's operations. It was backing JP Morgan's interest rate swaps, and Goldman Sachs's credit default swaps, and Citigroup's currency derivatives. 1 physical share, 4 different claims against it. The Bank for International Settlements estimates that the global derivatives market now exceeds $600 trillion in notional value. These are bets on interest rates, currencies, commodities, and credit events that dwarf the actual underlying economy. And what's backing these massive leverage positions? Collateral, your collateral. The shares you think you own are sitting in a chain of pledges so complex that even the banks themselves can't fully map the interconnections. The Financial Stability Board published a report warning that collateral reuse has created a shadow banking system where the same assets are being counted multiple times across different institutions' balance sheets. Here's where it gets truly frightening. Let's say we hit 2026 and the commercial real estate crash triggers a wave of bank failures. Your broker, facing a liquidity crisis, can't meet its obligations. The broker files for bankruptcy protection. What happens to your shares? According to the Bankruptcy Code in UCC Article 9, there's a very specific priority hierarchy for who gets paid. And you're at the bottom of that list. First in line are the secured creditors. These are the major banks and financial institutions that lent money to your broker with specific collateral pledged against those loans. They have a perfected security interest, which is the legal gold standard of claims. When the bankruptcy trustee starts liquidating assets, the secured creditors get paid in full before anyone else sees a penny. These are the too-big-to-fail institutions that finance the entire securities industry. JP Morgan Chase, Bank of America, Citigroup. They wrote the rules and they made sure they get paid first. Next come the administrative expenses of the bankruptcy itself. Lawyers, accountants, trustees, they all get their fees. Then come priority claims like taxes and employee wages. Then come general unsecured creditors, which might include your broker's landlord, their office suppliers, their consultants. And finally, at the very end of the line, come the customers with security entitlements. That's you. You're an unsecured creditor in bankruptcy court, fighting for whatever scraps are left, after everyone else has been made whole. The Securities Investor Protection Corporation, or SIPC, is supposed to protect you with insurance up to $500,000. But here's what they don't advertise. SIPC only protects against broker theft or fraud, not against market losses or systemic failure. And SIPC's total fund is only about $4 billion. If we have multiple major brokerages fail simultaneously in a systemic crisis, that $4 billion evaporates instantly. According to SIPC's own financial statements, they could handle maybe 1 or 2 medium-sized broker failures. But in a 2026 level crash where the entire custody and clearing system is under stress, you're going to be standing in bankruptcy court with a claim against an insolvent entity, watching secured creditors walk away with the assets you thought were yours. You don't have to take my word for this. We've already seen it happen. In Cyprus in 2013, the banking system collapsed. The government, facing pressure from the European Union and the International Monetary Fund, implemented something called a bail-in. Instead of using taxpayer money to rescue the banks, they confiscated depositor funds. Anyone with more than 100,000 euros in a Cypriot bank account woke up one morning to find that 47.5% of their money was gone. It wasn't stolen. It was legally converted into worthless bank equity to recapitalize the failed institutions. The depositors became unsecured creditors. Their money became the bank's emergency fund. This wasn't some third-world financial experiment. This was a European Union member country implementing a policy framework that had been developed by the Financial Stability Board, an international body that coordinates financial regulation for the G20 nations. And here's the critical detail. The United States adopted the same framework. It's written into the Dodd-Frank Wall Street Reform Act of 2010. Title II of that law gives the Federal Deposit Insurance Corporation the authority to implement what they call an orderly liquidation of a failing financial institution. Section 210 explicitly allows the FDIC to treat similar creditors differently which means they can protect institutional creditors while wiping out retail investors. They can bail in the system using customer assets. The Federal Reserve and the FDIC have published multiple papers and conducted simulation exercises on how to implement these bail-in procedures. In 2014, the Financial Stability Board released a document titled Adequacy of Loss-Absorbing Capacity of Global Systemically Important Banks in Resolution. It's a bureaucratic title for a terrifying concept. When the big banks fail, they will absorb losses by converting liabilities into equity. Your deposits, your security entitlements, your assets become their rescue fund. Think about what happened in March 2023 with Silicon Valley Bank and First Republic Bank. The FDIC seized these institutions over a weekend. Depositors above the insurance limit faced potential losses until the government stepped in with emergency measures. But those emergency measures required political will and available resources. What happens in 2026 when it's not 2 regional banks failing, but 10 major institutions simultaneously? What happens when the Federal Reserve has already expanded its balance sheet to the breaking point and Congress is paralyzed by political gridlock? The emergency measures won't be there. The bail-in mechanisms will activate automatically. And here's the part that makes this unstoppable. The infrastructure for instant confiscation is already built. We're rapidly moving towards central bank digital currencies and tokenized securities. The Federal Reserve has been testing a digital dollar. Major banks are developing blockchain-based settlement systems. The DTCC has announced initiatives to tokenize securities and move toward real-time settlement. This technology is being sold as innovation and efficiency, but it also creates the technical capability to freeze, seize, or delete financial assets at the speed of light. You need to understand what this means in practical terms. In the old days, if there was a financial crisis and the government wanted to confiscate assets, they'd have to send people to banks. There would be lines, panic, time to react. But with digital systems, they don't need to send anyone anywhere. Your security entitlement exists as a database entry. When the bail-in is triggered, an algorithm changes your balance from $500,000 to zero. It happens in milliseconds. There's no bank run because there's nowhere to run. The gates are already closed before you even know the crisis started. The International Monetary Fund published a working paper in 2022 discussing the benefits of CBDCs for implementing capital controls and financial repression. They used polite economic language, but the implications were clear. Digital currencies give governments and central banks unprecedented power to control, monitor, and confiscate private wealth. When your money exists only as digital entries controlled by centralized institutions, you don't own money anymore. You have permission to access it until that permission is revoked. This is why the move from physical certificates to digital entitlements, from tangible assets to database entries, from property rights to contractual claims, matters so much. Every step in this evolution has reduced your actual control over your own wealth, while increasing the system's ability to appropriate it in a crisis. And the people who design this system are the same people who will benefit when it's activated. They are the secured creditors. They are the too-big-to-fail institutions. They are the ones holding the collateral chains that run through your assets. In 2026, when the derivatives unwind and the margin calls start cascading through the system, you're going to see brokerages freeze withdrawals just like Robinhood did during the GameStop squeeze, except this time, it won't be temporary. You're going to see accounts locked while bankruptcy proceedings determine priority. You're going to see depositors and investors converted into equity holders of worthless financial institutions. And you're going to see the largest wealth transfer in American history as retail assets are legally confiscated to bail out the institutional creditors who created the crisis in the first place. This isn't a bailout where taxpayers fund the rescue. This is a bail-in where your assets are the rescue fund. And it's not coming. It's already here. The laws are passed. The mechanisms are built. The precedents are established. All that's missing is the trigger. And if you're paying attention to commercial real estate delinquencies, corporate debt refinancing walls, and bank unrealized losses, you can see that trigger approaching fast. Now, here's what you actually came here to learn: how to get out of this trap before it closes. Because there is a way to legally reclaim true ownership of your stocks. And there are assets that cannot be touched by the bail-in mechanism, no matter what happens to the financial system. Let me introduce you to something called the Direct Registration System, or DRS. This is the only way for a retail investor to become the actual registered owner of a stock instead of just a beneficial owner with a security entitlement. When you direct register your shares, they are removed from the pooled account at the DTCC and transferred directly into your name on the company's official shareholder registry. You become the registered owner. The share certificate, even if it's electronic, is titled to you personally, not to CD and Company, not to your broker's nominee name, to you. This changes everything from a legal standpoint. When your shares are held in direct registration, they are not on your broker's balance sheet. They cannot be used as collateral by custodian banks. They cannot be rehypothecated into derivative chains. They are not part of the pooled securities account that becomes property of the estate in a bankruptcy. According to property law, if an asset is titled in your name and held outside the failing institution, it cannot be seized to satisfy that institution's creditors. Your DRS shares are your private property, completely separated from the financial intermediaries who created the systemic risk. The process is straightforward, but most investors have never heard of it because brokers don't advertise this option. You contact your broker and request a direct registration transfer for specific shares. The broker is legally required to comply, though they might make it difficult or claim it takes several weeks. They have to submit the transfer request to the company's transfer agent, which is usually a firm like Computershare or AST Financial. The transfer agent removes the shares from the DTCC's nominee name and registers them directly to you. You receive official documentation showing you as the registered shareholder. Some companies even issue physical certificates if you request them, though most use electronic book entry registration. Here's what you need to understand about why this matters for 2026. When a brokerage fails, the bankruptcy trustee takes control of all assets held by that brokerage. Your shares held in street name are assets of your brokerage's account at the custodian bank. But your DRS shares aren't held by the brokerage at all. They're held by you through the company's transfer agent. The bankruptcy trustee has no claim to them because they were never part of the brokerage's estate. According to bankruptcy law, properly titled property held outside the debtor's possession cannot be included in the bankruptcy estate. Your DRS shares are outside the system. Think about this scenario. It's 2026. Commercial real estate defaults trigger a cascade of bank failures. Your broker announces they're freezing all accounts, pending restructuring, and you watch your retirement savings get locked in bankruptcy proceedings. But you direct registered half your portfolio 6 months earlier. Those shares are sitting in your Computershare account, completely untouched by the crisis. You can still sell them if you want, though you'd have to transfer them back to a broker first, which takes a few days. But the critical point is that they cannot be seized, cannot be rehypothecated, and cannot be converted into equity of a failed institution. They are your property, held in your name, outside the collateral chains that are collapsing around you. The GameStop investors figured this out in 2021 and 2022. Millions of retail shareholders direct registered their shares specifically to remove them from the lending pool and prove actual ownership. According to GameStop's quarterly SEC filings, over 75 million shares were directly registered by individual investors, representing a significant portion of the company's outstanding stock. These investors weren't doing it for financial theory. They were doing it because they understood that beneficial ownership through a broker gives you a contractual claim, while direct registration gives you property rights. Now, let's talk about the assets that have zero counterparty risk because they exist completely outside the banking system. Physical gold is the obvious example. When you hold a gold coin or bar in your possession, there are no intermediaries between you and the asset. No broker can fail. No custodian can rehypothecate it. No government database can delete it. According to the World Gold Council, central banks added over 1,000 tons of gold to their reserves in recent years, the highest levels of official sector buying in decades. Why? Because in a systemic crisis, gold cannot be bailed in. It's no one else's liability. It's just gold. The same principle applies to land. If you own real estate with a clear title, that property cannot be seized to satisfy a bank's creditors unless you personally defaulted on a mortgage secured by that property. Your land isn't on anyone's balance sheet except your own. It can't be rehypothecated. It doesn't have a security entitlement. It's real property, legally protected by centuries of property rights precedent. During times of financial system collapse, hard assets with clear titles hold their value because they exist independent of the credit system that's failing. Bitcoin, when held in true self-custody with your own private keys, operates on the same principle. If you control the private keys and the Bitcoin is stored in your own wallet, not on an exchange, you have direct possession of a digital asset that exists outside the traditional financial system. The critical detail is self-custody. If your Bitcoin is on Coinbase or any other exchange, you're back to the same security entitlement problem. The exchange holds the Bitcoin, you hold a claim against the exchange. But if you control the keys in a hardware wallet or properly secured software wallet, that Bitcoin cannot be confiscated in a banking system collapse because it was never in the banking system to begin with. Here's what a properly protected portfolio looks like going into 2026. You take the stocks you want to keep long-term and you direct register them. It takes effort and your broker will make it annoying, but you do it anyway because you understand what happens in bankruptcy court. You take a meaningful portion of your liquid wealth and you convert it into physical gold or silver that you can personally possess or store in a private vault that's not part of the banking system. You take some allocation and you put it into Bitcoin in true self-custody where you control the private keys. And you seriously consider owning real property with a clear title, whether that's your primary residence or investment land, because real estate held in your name cannot be bailed in by Bank of America's derivative losses. What you're doing is removing your assets from the category of financial claims and moving them into the category of direct ownership. Financial claims depend on the solvency of intermediaries. Direct ownership exists independent of anyone else's balance sheet. In a functioning financial system, this distinction doesn't matter much, but we're not heading into a functioning financial system. We're heading into the collapse of the most leveraged, most interconnected, most fragile credit bubble in human history. And when that bubble pops, the difference between holding claims and holding property becomes the difference between financial survival and financial annihilation. Let me be very clear about the timeline. We likely have months, not years, before the gates slam shut. When regional bank stress returns, when commercial real estate losses force major write-downs, when the derivatives unwind begins, brokerages will freeze transfers. They'll claim it's for your protection or for operational reasons, but the real reason will be that they cannot allow a mass exodus of assets from their balance sheets while they're trying to meet margin calls. Robinhood stopping GameStop trading was a preview. They shut down the buy button because Citadel demanded more collateral, and Robinhood couldn't meet the requirement. In 2026, they won't just stop buying. They'll stop everything. No transfers out, no direct registration, no withdrawals. Just a message on your screen saying your account is temporarily restricted while they work through liquidity issues. And once that freeze happens, once the bankruptcy proceedings start, you have lost your window. You become an unsecured creditor, arguing in court about the priority of your claim while secured institutional creditors walk away with the actual assets. By the time the bankruptcy trustee determines how much you might recover, your $500,000 portfolio might be worth $50,000 in settlement payments spread over years of legal proceedings. This has already happened to investors in broker-dealer bankruptcies. MF Global collapsed in 2011, and customers with segregated accounts, which were supposed to be protected, spent years in bankruptcy court fighting for partial recovery. And that was a single broker failure during a stable period. Imagine the same process during a systemic crisis, when multiple institutions fail simultaneously and the courts are overwhelmed with millions of claims. You need to understand something crucial. The financial industry does not want you to know about direct registration. They don't advertise it. They make it difficult. They tell you it's unnecessary or inconvenient. And there's a very simple reason for this. Your shares held in street name are the raw material of their business model. They lend them out to short sellers and collect fees. They use them as collateral for their own leverage. They count them on their balance sheet as assets under management. When you direct register, you remove those shares from their system. You break the rehypothecation chain. You reduce their available collateral pool. You make their business model slightly less profitable. And most importantly, you protect yourself from their bankruptcy risk. The same applies to gold and Bitcoin. The financial industry wants your gold in their vault and your Bitcoin on their exchange because then they control it. They can lend it, lease it, use it as collateral, and most importantly, they can trap it in their bankruptcy estate if they fail. When you take physical possession of gold or true self-custody of Bitcoin, you are explicitly rejecting the intermediary model that creates systemic risk. You are declaring that you understand the difference between owning an asset and owning a claim to an asset, and you are protecting yourself from the legal mechanisms that allow your wealth to be confiscated to save institutions that are too big to fail but too criminal to prosecute. Here's my final warning, and I need you to hear this clearly. If you don't hold it, you don't own it. This isn't a philosophical statement. It's a legal reality that will destroy the savings of millions of Americans who believe their broker statements represent actual ownership. The security entitlement structure was designed specifically to facilitate the rehypothecation chains that create systemic risk. The bankruptcy priority rules were written specifically to protect secured institutional creditors at the expense of retail investors. The bail-in mechanisms are already law. The digital infrastructure for instant confiscation is already built. The only question is when the trigger gets pulled. You have a choice right now. You can continue believing that the shares shown on your phone screen are yours just because your account says so. You can trust that the system will protect you despite all the evidence that the system is designed to sacrifice you. You can wait and hope that 2026 won't be as bad as the warning signs suggest. Or you can take action now while you still can. You can direct register your stocks. You can convert paper claims into hard assets. You can remove your wealth from the financial system before the financial system collapses and takes your wealth with it. The investors who survive the next crisis won't be the ones with the best diversified portfolios of security entitlements. They'll be the ones who understood property rights and acted on that understanding before it was too late. They'll be the ones who held actual assets in their actual names, outside the collateral chains that are about to snap. They'll be the ones who realize that, in a systemic failure, your legal claim to ownership matters infinitely more than your belief in ownership. The difference between registered ownership and beneficial ownership seems like a technicality until the bankruptcy judge explains why the secured creditors get paid first. The difference between holding gold in a vault and holding a gold ETF in a brokerage seems trivial until the ETF sponsor announces they're suspending redemptions. The difference between controlling your Bitcoin keys and leaving Bitcoin on an exchange seems like a minor convenience until the exchange files for Chapter 11 and your crypto becomes property of the estate. You now know what most investors don't. You don't own your stocks. You own a promise that can be broken. You know the legal mechanisms exist to confiscate retail assets to bail in the system. You know the crisis is coming and the timeline is short. The only question left is what you're going to do about it. Because in 2026, when the derivative bubble pops and the bankruptcies begin, there will be two types of investors: those who hold title to actual property outside the system and those who hold claims. Against insolvent institutions, choose wisely. The window is closing.